Welcome to online lectures by CA Studies. For more lectures online, please do visit castudies.lk.
Hi guys, welcome back. In this video, we will be starting chapter 3, which is compounding and discounting, and this will be broken to several videos as it's a long chapter. Also remember, compounding and discounting is a very important chapter in your syllabus. So please pay attention to all the concepts discussed here because it's the foundation for your CA studies in the future as well, which is for the subjects in the corporate level and strategic level. Okay. So compounding and discounting, we will be introducing you in this chapter to the concept of time value for money, and with that we will discuss on simple and compound interest rates, effective annual interest rates which relates to compound interest, single cash flow types under which we will calculate future values and present values, then regular cash flow types where we'll be calculating future values and present values. Especially a very special note where you have to know about advances and arrears. This is so tricky, they always question you. So you have to identify whether a payment is in advance or arrears in order to apply the correct formula and find your future value or present value. Apart from that, finally we have reverse calculation to find initial investment value, which is a very simple thing, relates to your second chapter, which is on equations, where we made the missing value the subject of the equation. I hope you all remember that. Same thing only we are going to do it here for the future value formula. And just to make sure that for any formula they ask, you will apply this. Alright, so coming back to the chapter, what is compounding? Compounding means you are finding the value of today's money in future. That action of finding is called compounding. But if you are finding the future value, I mean, let's say you know the future value and you want to know the value of that future value today. That is called present value. So, the reason why today's money is not equal to the money in 10 years is because the value of the money reduces. So that's why we say time value of money has a future value and also a present value. It creates a future value and it creates a present value because of time. Example, if you see, now if you go to a supermarket today to buy, rice, milk, eggs, day-to-day item for food, you might maybe buy for around 250 rupees now. But just imagine in another 10 years time, can you buy the same amount of food for the same price? Meaning rice, milk, eggs, could you buy for 250 rupees? In 10 years, that means now we are in 2021, so 2031, can you buy for 250 rupees? No. Why do you think it's no? Because the price increases. The price of all the products increases. That's the reason we cannot say that 250 rupees worth goods can be bought for the same 250 rupees in 10 years time, because In 10 years, 1 kilo of rice may be equal to 250 rupees. But in today, rice, milk and eggs are all equal to 250 rupees. But in 10 years, maybe only the rice is equal to 250 rupees and the milk and eggs have a different price. Alright. So, the concept therefore is inflation caused a gap between today's value and 10 years value for the same number of items. That's the key word. You can't say today I bought 10 items, that is 250 rupees. 10 years time I bought 5 items and that's 250 rupees. I mean, that's a concept, true. The time value of money it shows, but you can't compare 5 with 10 items. You have to compare for 10 items I got 250 rupees. So in 10 years time, for 10 items, can I buy it still for 250 rupees? And the answer would be no. Why? Because in 10 years time, your price will surely be increased or decreased. Something will happen because 10 years is very revolutionary. Because COVID happened to be only like 2 years and 1 year I guess, yeah, no 2. So what happened? Prices fluctuated, economies changed, all of that happened. So what you have to remember is today's money worth will not be equal to future value of the same amount of money. I hope you all got the concept that I am explained. So let's so if you are to put it in a timeline, okay, where today you are buying for 250 rupees rice and eggs and milk. But after 10 years, prices increased by 10%. Now what? Your overall price, for example, became 275 for rice, eggs and milk. So you see, same item price changed because of this gap of time. So time value of money creates a future value and a present value. The future value is the value here, 275. This is the future value. Future, no, futuristic. Simply go with the word. Present value means today's value or the value now. Okay. So that is here, this is today's value, no? So this, so 250 will be your present value. So one reason we discussed for this change in value is price increases, right? Price increases was one reason. What could be another reason? If we take opportunity cost, where let's say you bought rice, eggs and milk for 250 rupees, rather you could buy some stationery or some other consumption item. Let's say something other food consumption, so that it's on the same category. Consumption item for 250 you could have bought. This is the important word in opportunity cost. Could have. Maybe you could have bought. Okay. another food category for consumption. So the missed chance now, but you have only 250 rupees, right? So just think, you have 250 rupees to buy rice, milk and eggs. And you have the chance using the same 250 rupees to buy another food item. Let's say a burger. Now what would you have to choose? One out of the two, because you have only 250 rupees, not 500 rupees. Okay, so your choice of choosing one category to buy makes you lose the chance of buying another item. That lost chance is called opportunity cost. Alright, so how it affects time value of money means, so you're taking a risk. Let's say, so let's look at it like this. You spent 250 rupees to buy something. But if you didn't buy, without buying, you could have put your money in the bank. I mean, let's say it's 2,500 rupees. Then the money in the bank will give you an interest in 1 year. Right? FD or current account, no, savings account. It gives you monthly interest. Something will come to your account and at the end of the year you will have your annual interest. But without depositing in the bank, you're spending the money to buy an item. That lost opportunity of not being able to invest in the bank is opportunity cost and creates the time value of money highly. Because if you could have invested in the bank, you would have got a higher amount in 1 year. Now this is in year 1. So opportunity cost means you're here, okay, year 0, you're in the beginning of the year. Now, or today, this is year 0 is represented by today. Remember that, it's very, very important. I'll also touch it up as we go forward, but just remember year 0 is today. So, you spend today or earn double in 1 year. Okay. So you lost this because you spent today. That loss is also affects the time value of money. It affects the time value of money. Okay, because of timing. Timing difference, cost and opportunity cost. A larger opportunity cost. Right? And when it comes to interest, you know, I just spoke about interest where you would earn double when you deposit a value in your fixed deposit account. So, why the bank is paying you interest when you put money in the bank? Why did you ever think why the bank is paying you interest? Is it happy to give you some amount? It can keep the same money and give the same amount to you in 1 year. No? That's profit for them. No? They don't have to, you know, give you interest extra from their own funds. Why do you think they have to do that? That's because, let's say, you invested fixed deposits. You're investing money today, which is represented by year 0, of amount 2,500 in a bank. Okay. And then bank promises you to pay interest in 1 year's time at 10%. Okay. So 10% add on to 2,500, how much? Remember your percentage calculations where you multiply 2,500 into 110% to get your future value. Okay, recall those, alright. So 2,500 multiplied by 110% is equal to 2,750. So this includes 2,500 plus your interest earned of 250 interest. Now, why the bank pays you an interest is because the value of money you put today is not equal to the value of the same money in 1 year's time or even 1 day after it. By even a decimal cent it will change, but in 1 year's time. Okay, in this scenario and in general cases, fixed deposits work for 1 year, savings accounts, so on forth. So bank doesn't want to tell their customer, look, you could put your money in our bank so that we could do all the fund collections, fund withdrawals and manage it within the bank, and in 1 year time we will give your money back. And same 2,500 rupees itself will return, don't worry. Bank will never say so. Because if they say so, the customer will get angry. Why? Because the customer will say, why do you want to keep my money in your bank? I can keep it in my Almirah. No? So I can save it for 1 year and I can use. Like why? Because in 1 year if I save it in my home, if I keep my money in the home, I can get the same number of money or notes, 2,500. I'll be having it still. Why should I give it to a third party whom I'm not sure of also? Right? That's how the thinking happens. And then customer says, and in 1 year time, prices will increase. So if you give me in 1 year time 2,500, it won't be valuable for me as it is valuable today. Because today's value is not tomorrow's value. Right? So customer will never agree to 0% interest. He will say, give me some extra. Give me something that compensates the value in the future so that I can afford to buy the goods that I am able to buy today with 2,500 rupees in year 1 as well. Okay, I hope you all got it. So that is the only reason why banks pay you interest on savings. Alright, so that's the reason. Because today's money is never equal to tomorrow's money. So nobody can save on behalf of you. Because you will argue, come on, I cannot give my money to you and you pay the same number of money, the number of notes tomorrow or in 1 week's time, but I can't make a purchase that I could make today. Right? So, we would say this is the present value of money, which is 2,500. The reason for interest is because 2,500 today is greater than 2,500 in 1 year's time. Its value is greater. That's the reason banks pay you interest of 10%. Yeah, no, let's say here it plus 10%. Then it will be, what will happen if it plus 10%? This will change to equal. Alright. Without 10%, this is today's value is greater than tomorrow's value. But with 10% additional, today's value and 1 year's value will be equal. That's the key learning point from this chapter, time value of money. Alright. So please remember the reasons for why time value changes, but probably they won't ask question on factors that affect time value of money, but it is very important for you to understand the concept of time value of money, because it's a foundation, as I told earlier. Refer back to your tute, refer back to your notes, be very clear, because this is a high mark scoring area, and you should make the best. So and this is a fundamental in your CA studies when it comes to management accounting. This is what management accountants do, and this is what finance guys do. So very important concept, very well remember this idea of time value of money, which is today's value will not be equal to tomorrow's value. So we spoke about this concept at the beginning called compounding and discounting. Compounding, in this case, what it is? What is compounding? It is the addition of this 10%. The addition of 10% onto the original value, that action is called compounding. Alright, so that is what it is. So by compounding present values, you can get future values. Then if you know the future value and you are trying to find today's value, okay, in future they said they will give me 10,000 rupees. If I receive that 10,000 rupees today, I mean in today's price terms, what will be the value? Then in this case, so then if we are to draw it, they are saying 10,000 we will give you in 1 year time. What is the value of 10,000 today is our question. Reverse finding is called, that action is called discounting. Forward calculation from present value to finding what is the future value, that action is called compounding. Alright. So please remember, compounding means from you are going to find the future value using the present value. Whereas discounting means you are going to find the present value using future value. Alright. So we will be learning how to calculate compound interest and what is meant by simple interest. Also we will look at the annual interest, how to calculate when they give us monthly interest values in the next video.
Thank you for watching the video. Stay tuned with castudies.lk for more lectures online.